morning, everyone. Thank you so much for joining us on another of our advisor webinar series. It's very nice to have you all here again. And today we have the pleasure of listening to Charlie Parker from Albemarle, and his presentation is one that I'm really looking forward to listening to. It's talking about mindful markets. And I think this topic is going to be extremely interesting. We do a lot of sort of more technical and market type presentations, but I think this presentation and the content within it is equally as important. So today, Charlie's going to be focusing around understanding the psychological factors that influence investors and their behaviours, which I think is really important. And along with that, some strategies to mitigate anxiety, which I'm sure we're all feeling at the moment. There's elections going around and there's lots of uncertainty. So these conversations will be ones that I'm sure you're having with your own client base on a regular basis. So Charlie will be running through some of those strategies that you could potentially put in place to mitigate anxiety and that effect that it has on people's investment decisions. And then also some tools and techniques for having more constructive market conversations, which again is a part of our job that we all do. But it's not something that's really sort of discussed. It's more sort of focused on performance and figures. So I think this will be a really interesting conversation today. As usual, we have the Q&A button at the bottom of your screen. So what we'd love is for you to submit any questions that you might have as the presentation goes through. And we'll have about 10 minutes or so at the end of the presentation where we can field those questions to Charlie. And so please feel free to submit those questions through that Q&A button at the bottom. But without further ado, I'm going to hand you over to Charlie and today's presentation. Thank you.
Well, thank you very, very much, Linda, and a very good morning, everybody. As Linda said, I'm going to be talking about this question of investor anxiety and really just sharing some of the thoughts we've had, some of the kind of illustrations and graphics that we've developed with the advisors who work with us to try and have better conversations with clients, particularly when they're at those moments of high anxiety, and it's really difficult to help them make good decisions. Now, I'm not going to do a load of spiel on Albemarle Street Partners today, don't worry, but just so you know who we are, we're a boutique discretionary investment manager. We work with a really focused group of great independently minded financial advisors, as we call them, although in my experience, most financial advisors are pretty independently minded, to put it mildly, across the country to deliver investment propositions. And we like to think what makes us different is that, like many advisory businesses, we built this thing from scratch, and our commitment to really helping people get what they need, get financial advisors, getting an investment proposition shaped around what they need is absolute. And we're really pleased to work with Novia Global on stuff, because one of the things we do that we think is a bit different is we build asset allocations and investment portfolios for clients who operate in a variety of different currencies. Really think that people underestimate how important it is that an investment proposition is built from scratch for internationally mobile clients who are spending and living in different currencies. And obviously the very lovely people at Novia Global are able to support that. So that's all I'll say about us. That's some of the great advisors who work with us and form a brilliant community. Oh, and look, there's some of us, some prettier than others. There you go. So learning outcomes today: explore the role of anxiety in driving long-term investment outcomes, explore how to distinguish between risk aversion and anxiety, explore ways of communicating with clients to help reduce behaviors associated with anxiety, and then just share some of the graphics that we've developed. We published something called the Investor's Guide to Market, which is a big pack of illustrations aimed to help you have conversations with clients that very happy to send out to you guys, and you can repackage and use as you want. And we're always developing that, always putting new illustrations in. So let's start with this question of anxiety and why we're focusing on anxiety. Well, we're focusing on anxiety because investor anxiety, as it turns out, is one of the primary things that is associated with whether people get and stay in the stock market throughout their lives, with levels of stock market participation through their lives as investors. And obviously, we all know that fundamentally, for people to get the retirements they need, to get the long-term outcomes they need, to leave the money behind to loved ones that they need, They need to get into the stock market as early as possible and stay there, not panic, not sell out at critical junctures when they get a bit of bad news. And in America, they've done big survey data of what is influencing stock market participation levels. And you can see that on the graph there. Most of the things that are negatively correlated to getting invested and staying invested, that's the lines coming down. Well, they're things that financial advisors, frankly, can't do a great deal about. It's your religion, it's your income level. Obviously, more income, you save more. People who are unmarried, who are less attached, who've got less responsibilities, tend to invest less. Well, unless we're going to go out and be, relationship counselors or evangelize people into different religions, we can't do much about those things. But the one thing that you can see from that graph is really powerfully correlated to not getting and not staying in the market is anxiety. And in fact, in the academic research done around this, they split people into quadrants, from the least anxious people to the highest anxious people, high tendency anxiety, they call it. And they found that every step of the way, the more anxious you were as a person, the worse retirement you are having. So this is, for me, a profoundly important thing for financial advisors to address. And it's also a brilliant defense of the purpose and point of face-to-face financial advice. People often say, what's the point of having an industry where there's thousands of different companies delivering financial advice face-to-face? Isn't it inefficient? Well, it might be a bit inefficient, but the only way you can really help a human being who is making a bad life decision because of anxiety is to build a relationship of trust with that individual. The reason we have lots of different advisory firms in this country is because those firms are close to the people. And that's what makes the absolute difference in our view. Now, the regulation on this doesn't, of course, always help us, because what the regulation tells us to do is it says you have to go in and see a client and you have to understand two things. Firstly, their capacity for loss. Okay, fair enough. That's mathematical. You can calculate that. But you're also required to calculate their attitude to risk. And you can use the most sophisticated, brilliant risk profiling softwares in the world, and it will kick out a number and tell you someone's attitude to risk. The problem is, of course, the attitude to risk is not made up of just one thing. It's made up of two things. It's made up of a rational aversion to risk, which is driven by a desire to only take the amount of risk you need to take to get to your goals. And it's also driven by a completely irrational anxiety. Now, the aversion to risk that is rational is helping investors reach their goals. The anxiety could be working away from those goals. And no bit of software, no digital system, however beautiful, is unfortunately going to help you with the devilishly difficult task of separating those two things. Only face-to-face human beings can do that. Now, if you want to hear an academic description of what I'm describing, here's one to get going with. Anxiety is an anticipatory emotion experienced prior to the resolution of uncertainty. It's related to the feeling of living with uncertainty. In contrast, risk aversion is a static concept pertaining to the curvature of the utility function within a period. What does that mean? Well, it essentially means this. This is our official frontier of our portfolios, risk and return up the axes. You'll have seen these. Risk aversion that's rational keeps you on that line. Anxiety pulls you away from that line. And I believe it's one of the main social responsibilities and social goods of the financial advice market to face-to-face help people at that absolutely vital moment in their life where they could be experiencing a feeling. And that feeling, if left unchecked and unchallenged and unmanaged by a trusted advisor, could actually lead to a completely different outcome for them throughout their entire lives. Now, what is the problem with anxiety? What does anxiety do that causes a problem? Well, I think it does kind of three things. Firstly, it can lead us to not take enough risk at the very start of your investment journey. Secondly, it can lead to the wrong response at critical junctures. It can lead you to panic and sell when you shouldn't tell. And thirdly, and I think this is a kind of more subtle impact of anxiety, it can lead people to over-allocate to things that make them feel safe, that make them feel a comfort and less emotion than they would otherwise feel. And we're going to talk through some of the different ways that we can address those issues. Now, what is the basic problem with anxiety is that our brains are strange things. Our brains were basically designed and built for people who are living in the savannah, hunting for our food, trying to avoid predators. And therefore, anxiety is basically a surge of cortisol, a surge of our amygdala, which is the bit of our brain that controls our threat response, that tells us that our life is in danger, that we are about to be attacked and we face a threat to our lives that we need to respond to. Now, what happens when our amygdala gets fired up? Well, what happens is that the main thing our brain does, which is it hunts for patterns. We are basically pattern hunting machines. Our brains get fired up and we look for patterns where perhaps those patterns don't exist. So that's why when everyone thinks everyone's out to get them, it's because they're piecing together little interactions they might have had with people over the course of a day, concluding that they form a pattern that proves that everyone's out to get them. Now, a rational person looking in will say, there's no pattern at all there. But when our amygdala is fired up, we're overly hunting for patterns. And the problem with the world is, if there's enough variables out there, patterns will appear, even if those patterns mean nothing. It's why when you look up at the night sky, people can see shapes between the stars. Doesn't mean there's any reason there's any shape between those stars. It just means that if you've got enough dots in the sky, some of them will make shapes. And when we're in a high anxious state, we are joining dots aggressively and quickly. But because all our energy is surging into our amygdala, the bit of our brain that processes those patterns, the bit of our brain that works out whether those patterns do actually mean something or nothing, is shut down. So we've got a hyper tendency to identify patterns, and we've got a much weaker tendency to analyze and work out what those patterns actually mean. Now, clearly, this is a big problem for investment, because investment is about assembling data and evidence and making a judgment. And if you're in a high anxious state, you're clearly assembling data that might mean nothing at all. Incidentally, as an aside, we mentioned the election. When I was doing the research on this, I discovered that, believe it or not, people who vote Conservative have a physically larger amygdala in their brain than people who vote Labour. And the academic who chose that this is what he was going to spend his life analysing, fair enough, says this is because people who vote Conservative have a bigger threat response. They are reluctant to embark on big untested projects or plans, or they're reluctant to experience disorder or chaos. And so they vote Conservative. So you can make a judgment yourself about whether that worked out for people, but that's what the research says. Anyway, let's get back to this. So how can anxiety affect us at the very start of the process when we are trying to get people invested, and what can we do about it? Well, first of all, let me tell you a story, because the problem with anxiety and investment is it doesn't just affect private clients that you might meet in their living room to talk to about their money. In fact, it impacts everybody who invests. And I have seen really serious fund managers profoundly affected by the level of anxiety that they are experiencing. And indeed, the example that always comes to mind is a fund manager I managed in a previous role, a previous company. And I won't say who it is, but if I said the name, many of you would know the name. A well-known fund manager, good track record, became quite well known for his skills. But he had a really bad 2 or 3 year run. And the reason he had a bad run was because he kept panicking. His anxiety would overwhelm him, and he would basically flip the portfolio between bearish and bullish. And what I did as his line manager is about every 3 to 6 months, I would get the risk team to run an analysis of what would have happened to this portfolio if he hadn't changed anything. If it just had what he started the year with. And invariably, you'd go in and he'd have done better if he'd done nothing at all. And I had these meetings over and over again. Meanwhile, the guy's track record is just deteriorating. Clients are pulling money out of the fund. You're trying to get through to him. And I so vividly remember the last meeting I had about this with him, where he came in again and said, I've read some data. I think it was US pricing data, and I've got to turn this fund over. I've got to take it really defensive. Things are going to go really wrong. I remember looking this guy in the face and just saying, please, don't do it, because I knew that if he did, this is it. Like I know what's going to happen. I know that you make bad decisions in these moments, and I knew he'd run out of road. He wasn't going to be given any longer from the investors. And indeed, he went out there. He did it. His track record fell more. He had to leave. He's not working as a fund manager anymore. Fund managers, it's very hard for them to ever have a second act if it hasn't worked out. Now, I tell that story just to say that what I really wanted to do to that guy, who I liked and I thought was a clever person, if he didn't have to deal with this psychological issue, was I just wanted to basically do what they do to Mr. T in the A team when they want to get him on a flight. I wanted to put him an injection in his neck, send him to sleep for a few days, because I knew that if he could do that, if he could just do nothing for a little bit of time, he wouldn't be making this decision. And actually, the moment would pass, that the feeling of being overwhelmed by the data would pass, and he'd probably be all right. And actually, that is what is in all of the literature about dealing with investor anxiety. The single best thing you can do as a trusted advisor or as a line manager, whoever you are, is stop that person doing anything for a little while. Because what anxiety does is it tells us that the information we're receiving, the data we're receiving about the market is urgent. It tells us it's urgent because the threat response in our brain is a threat response designed to tell us that our life is in danger, except that our life is not in danger. We are just processing pieces of data that may or may not mean something. But an anxious state fires you up and you want to react more quickly. So the absolute best thing you can do for somebody is nothing. In fact, the academics use this kind of cheesy phrase, halt. Tell people not to make any decisions when they're hungry, anxious, lonely, or tired. Now, obviously, none of us would like to admit that that's the reason we're making decisions, but deep down, we know that those things actually have a much bigger impact on our decision making than we'd really like to accept. And so some of the people I talked to about this, some of the advisors say, you're absolutely right. I've even gone as far as to kind of lose the paperwork for a couple of weeks, to say to them, I'll get back to you. I just don't reply to an email for a couple of days. Now, that might seem a bit cheeky, but anxiety is by definition a transitory emotion. It comes and goes. And we'll have known this in our own lives. When something really goes wrong in our life, it triggers a whole load of anxiety. But somehow a week, 2 weeks, 3 weeks, 4 weeks later, even if we're still experiencing the same difficulty and challenge in our life, we've learned to cope with it and the anxiety has subsided. Human beings don't actually stay in crisis forever. We emerge from crisis even if the facts don't change. And so delaying a reaction which is being led by anxiety, a reaction that says don't take any risk or sell these shares, might be the single intervention, the simplest, but the single intervention that a financial advisor makes that has the biggest impact on someone's long-term life outcomes. So let's just look at some of the illustrations that we've developed for people at these moments in time when they are making that initial decision to invest. How do you try and help anxious investors in those moments? And please, we're not lecturing anyone here. You guys have got more experience of this than us. We're really just harvesting the stuff that's come back to us from the advisors who work with us. But one of the things we have seen is the absolutely vital point is that at the start of a relationship, if you want to make an anxious investor do something stupid, make them a promise you can't keep. And the promise that people make that they can't keep, I think most often, is to imply or to say that they know what is going to happen in the future. I still meet financial advisors who go into meetings and they talk about the geopolitics and the economics and the changes happening in the world, and they imply that they have a deeper understanding of these things than the client, and therefore they've chosen this discretionary manager or bought these funds in response to their insight about the future, and an investor should trust them for that reason. Of course, here's the problem. They haven't got a clue. None of us have a clue what's going to happen in the future. And so when that thing that we said will happen doesn't happen, the trust is broken. And at that moment, an investor who has a tendency towards anxiety might be lost for good. From that point on, they may never trust a trusted advisor again. Now, if there is anyone out there who thinks that guy's just not very clever, I am able to predict the future of what's going to happen in financial markets. Here's one of my favorite graphs to look at that topic. The blue line is just UK interest rates. We call this the hairy, scary graph because the little lines coming off it, that is what at every moment in time, the sum total of the wisdom of the Britons and the world's bond managers believed was about to happen to interest rates. All those strategic bond managers and everyone else, very clever guys, this is what they believe based on all the data was going to happen to interest rates. What story does it tell? Well, for 10 years, they forecast an interest rate rise that they believed was going to happen. It didn't happen until it did happen, and then they missed it, right? These are the brightest investors, the most numerate investors, the bond guys, the people who are trying to forecast the simplest thing about the future, the cost of money. Everything else we try to forecast, the progress of stock markets, particular companies, is more complicated than that. It requires us to make an assessment of the cost of money and then process a load of other variables to make a forecast. But actually, that simplest task are forecasting the cost of money, well, the sum total of the wisdom of the brightest people in the world, it cannot do it. So perhaps our starting point should probably be, we can't either. And we're much more likely to keep an anxious investor invested if we say that at the outset and simply demonstrate that we've been able to build a portfolio with the resilience to cope with a really wide range of outcomes that may happen. Here's a second thing that I think people have said can really help with anxious investors. And it's actually not so much to do with stopping anxiety as directing anxiety. Because invariably people tell us that the anxiety people come into the room with is an anxiety about losses, volatility, a fear that they're going to put their money in something, it's going to fall in price. They almost never come into the room with a rational fear that the safe things they're doing with their money will leave them with a shortfall risk, will mean that they don't get the retirement they need. And this is just one way we've chosen to illustrate that. It's just to say, let's imagine a hypothetical situation. In the year 2000, for some bizarre reason, you bought £100 of groceries, and you also put £100 aside to buy groceries 25 years later. And now you're going to take that £100 out and you're going to use it to go shopping. Well, if you put that money in shares, you've got 61% more. If you put it in bonds, you can put 21% more in your basket. If you put it in cash, adjusted for inflation, you've got to physically take things out of the basket. So to just try to convey to people that their anxiety may be misdirected. And here's another thing we often say. I think that often what anxious people do, and indeed I've done this in my life in all sorts of ways, is you look at the world around you and you try to convince yourself that the world is safe. So you try to say, if I'm going to invest my money in the stock market, I need to be optimistic about the economics and the politics. I need to believe in the government in America and the UK, and I need to believe the central bankers are rational. I need to believe they've got on top of the COVID pandemic and there's not going to be another war. And if I can go through all these fears and risks that I can see in the world, and I can persuade myself that they're not real or they're not important, well, maybe then I'll feel less anxious and I'll be willing to invest. But of course, anxiety doesn't work like that. The reality is, if you're anxious, even if you systematically, rationally work through every cause of anxiety that you are thinking about at that moment and dismiss them, guess what? Others will just pop up like whack-a-mole, because that is the nature of feeling anxiety. They call it filling the envelope of anxiety. You'll find something to put in there. So we always say, rather than go into that meeting trying to persuade people that it's a good or a safe time to invest, instead say to people, do you know what? There are problems in the world, but you do not need to believe in governments or in the central banks or in the current economic cycle or the valuation of equities to be invested for the next 20 years. And to know why, you need to understand what has driven shares up over the long term. And shares have risen for 120 years. They've risen through 2 pandemics, 2 world wars, the arrival and disappearance of communism from the capitalist system. Pretty much anything you can imagine throwing at the universe has happened in the last 120 years, and shares have carried on going up. Why is that? Because human beings have carried on making the economy more productive. We've carried on inventing things, and then over the long term, ordinary people find ways to take those things we've invented, work it into their lives, make the economy more productive, make companies more profitable, and in the long term, the stock market goes up. So stock market investing, it's not a bet on government, it's not a bet on today, it's not a bet on whether this is a good or a bad time to be invested. It's a bet on long-term belief in human productivity. Are we going to keep finding ways to make the world more productive? And I think right now, sitting on the cusp of artificial intelligence, robotics, and clean technology, we are on the cusp of the most significant wave of productivity gains the world has ever seen in a shorter period of time than occurred for digital networks, the motor car, the petrochemical industry, the aviation industry, or even arguably back to the Industrial Revolution. So there's plenty of reasons to believe in the long term. But a little bit like when you're teaching your kid to ride a bike, the job, I think, is to stop them looking at the wheel in front of them, because as you know, they then wobble it left to right, and instead look up at the road ahead. So let's move on to this second question of critical junctures. So what have we got that might help when you're in that horribly frustrating experience with a client who has seen something kind of bad going on in the world or something disruptive going on in the world? And they've done that pattern forming thing. They've pulled all these different bits of data together. There's a few in front of you. And they've said, all these things must somehow be linked. And that means that now is the moment to sell my shares. And you're sitting there thinking, please, please don't do do it. You want to get that sort of an anesthetic and put it in their neck and send them to sleep for a week and just wish they would do nothing until the moment had passed. How can we, because we're not allowed, unfortunately, to anesthetize clients, how can we help in those critical moments, those critical junctures? Well, here's one graphic we always show. I mentioned earlier that the problem with anxiety is you can't just dismiss whatever someone's worried about because they'll just find something else to worry about. And so I think that one of the first things we have to do is to say, yes, thank you for coming to see me. You have identified some real problems in the world. Those real problems represent real headwinds to stock markets. Here's the issue. Every single year, and we go back in this graphic 25 years, there's been a really good reason to sell your portfolio. Some of you, many of you will have lived through these times. I've lived through most of them. And I can tell you that at the time, each of these things felt like they could be world changing. In the global financial crisis in 2009, I was a journalist. I was sat on BBC News. I got a flash up on the screen in the studio in front of me saying Lehman Brothers had gone bust. The panic that surged through me on camera on that day was a panic that made me believe that it was possible that the financial system could actually collapse. It was possible that capitalism was broken, and you gather yourself and you try to say something reassuring, but the fear was real. And, so was the taper tantrum. So was the moment where US debt was downgraded for the first time. So was the pandemic. So was Brexit. So was all these things. They were very, very real problems. They weren't pretend problems. But guess what? If you had capitulated in the face of any one of them, you'd have missed a 567% gain in the stock market. Investing always requires us to bear with the bear argument. Here's another graphic we show. And I think often people say to us, is it a good or a bad time to invest? And what they forget is that it's generally a good time to invest. Most of the time, the stock market goes up. It has done for 120 years. And people often panic and say things like, the stock market's reached new highs. Should I be worried about this and sell? And you have to say, well, if it's gone up for 120 years, it's going to make a lot of new highs. Like that can't be in itself a sell signal, because you're going to be constantly selling. You're going to miss everything. And the good news is that bear markets, whilst horrible, whilst stressful, are actually pretty short. And it can help clients, I think, to just visualize that these periods are actually relatively brief, and that our job to just keep them invested. It doesn't run forever. It doesn't run years after year after year. It actually can run for some quite brief periods. Here's another one we show people. When we get that question, I think I should sell because this is a bad year. Well, the green dots show you the most the stock market fell in each year. And the red line is what it ultimately ended up for that year. So the reality is there is going to be a moment in most years where it feels like a dreadful year for markets. The fact that the market's fallen a lot this year doesn't actually tell us very much about how it will end up. If you had capitulated for any of those things, you would have missed out on all of the gains. Well, we've got lots of other graphics. I won't do all of them, but just to tell you they're available, and you'll have used this diversification one, I'm sure, in different guises with clients, but there's a very pretty version of it. I'm just going to pick then on that final kind of point about anxiety. What does anxiety do? Well, one thing it can do is it can make people want to only invest in things that make them feel safer. One of the things that makes people feel safer, of course, is property. If you're experiencing a lot of anxiety, well, it's actually quite scary for a financial advisor to put your money on a platform, however brilliant, like Novia Global. They can just log in, they see a number, the number keeps moving, they don't know why the number's moving. The advisor's telling them not to worry about the number moving, but it keeps moving, and that's an anxiety-inducing experience. Whereas property can give people a feeling of safety, particularly if you can buy a house near to where you live, and if something goes wrong, you can physically mend the toilet. You've got some agency. You've got the capacity to do something when your anxiety is surging, physically do something. And if you're experiencing fight or flight, doing something makes you feel better. So it's not surprising that anxious investors tend to flock around asset classes that make them feel safe. But within that, there's often an inherent misunderstanding, a belief that property investment is very safe and stock market investment is very risky. The reality actually is that property investment can itself be very, very risky. And we like to illustrate that with this graph. It suggests what would have happened to somebody who had bought an average UK house at the peak of the property boom in 1989. I'm sorry if this is triggering for anyone who bought a house at that moment in time, but if you had, actually, you would not have got back your money until 1998. You'd have had to go through the fall of Thatcher, the whole of the John Major years, and a bit of Blair as well. And you wouldn't have got back the actual buying power of your money until 2002, until after the turn of the millennium. Well, that is a very, very long time to experience losses from which you are not recovering. When losses are occurred over 10, 20 years, they don't just hurt you a bit, they change the whole outcome you get in retirement. And another graphic to show this, because people often also think that housing not just safer, but has just made loads more money than a typical investment portfolio. But it's actually not true. If you had put your money in a typical balanced portfolio 20 years ago and compared that to an investment in housing, and this is a typical portfolio, not the brilliant ones, obviously, that we run at Albemarle, which we'd hope would do better, but a typical one, you'd have to borrow £1.20 for every pound you invested in order to keep up. So actually, property doesn't often make much more money than a balanced portfolio, and it carries a lot of risk. Now, that's not to say property won't always be an important part of most people's portfolios, but if anxiety is robbing you of your capacity to achieve diversification, well, then it is changing your long-term investment outcomes. And I'll stop in just a moment. I'll just say this, couple of other graphics we've heard, and this is slightly off topic, but one of the most common conversations our advisors say to us, how do we have better conversations about this? Are those clients who come in and they say, you've put me in this diversified portfolio, but I can see from space that there is one thing that is doing incredibly well in the world, and anyone can see it. How have you idiots missed it? Why isn't all my money in that? Now, obviously, in the last few years, a particularly pertinent problem, because the thing that has worked is blindingly obvious. It's the largest companies in the world, in the United States, making the iPhones we carry. They're delivering our orders to our house with Amazon, or Nvidia, the AI stock that is always in the news. So it's most investors can see there is this extraordinary thing happening in technology. They can see that everything in technology is doing better than everything else, and so they come and they say, how on earth didn't you get this? Why did you diversify me in this way? And I think those conversations often have within them an inherent belief from the investor that, well, I know that if I put all my money in US tech, it might go down sometimes, but it'll come back up again. And I think we often are naive to the fact that stock market bubbles only ever occur in things that everyone loves. They only ever occur in the cool stuff. Stock market bubbles don't occur in unloved, miserable asset classes that no one wants. It's in the fun stuff. But when stock market bubbles do occur, if you are overexposed to them, they can destroy your entire lifetime as an investor. Now, people will say, well, I own 30 US companies, so that can't happen. Well, let's look at two examples. One is Japan. In the 1980s, the bad guys in the action movies, they were always Japanese, because at that moment, Japan was soaring. They seemed like they were taking the world. They seemed incredibly powerful. The land underneath the imperial palace in Marunouchi in Tokyo was worth more than the US stock market for a brief moment. An incredible bubble in Japan. And Japan just seemed like a miraculous economic thing. It seemed like a miracle. They were leading in technology. They were leading in ideas. Everyone wanted a Sony Walkman. It was real. It wasn't pretend. It was a real, unbelievable transformation in an economy. And then it crashed. Now, if you'd bought your Japanese market at the peak of that crash, you wouldn't even yet have your money back now, 25 years later, in real buying terms. It will have destroyed your whole lifetime as an investor. And actually, the same is true of US technology, where if you had bought the NASDAQ, the index of US shares that are exposed to technology at the peak of the bubble in 2000, well, you wouldn't have got your money back until 2015. You'd only have just got your real buying power back in 2018, 18 years later. You could argue it took another bubble for you to get your money back. So these are just some of the illustrations that we use to help clients with these difficult conversations. I hope you can see that our thinking on this comes off the back of just a real belief that it's human beings giving real advice that can do, as I mentioned, that really difficult job of separating rational risk aversion from the irrational anxiety, which can compromise ultimately the life that people have. Now, if you're interested in Albemarle, if anything I've said it seems reasonable, we've got some brilliant portfolio illustration tools that all of our clients can use at the point of investment, and that helps you visualize at the absolute outset what this portfolio can do. What are the risks attached to it? What's the risk of ruin, of running out of money if you're drawing money out of it? What's a good year and a bad year look like? What's a good month and a bad month look like? And that means that right at the start of the journey, you can have those very, very honest conversations, very easily and quickly visualize with a client what they need to understand to know what's coming, and therefore to hopefully get and stay invested through all the ups and downs of the stock market. When we built this proposal tool, we said our goal is that a financial advisor can know they've got a meeting coming up in 15 minutes time and can produce a compliant PDF to use within 3 to 4 minutes that will really help them in that meeting. We'd love to show it to you if you're of interest. And of course, you can see that for dollar, euro and pound portfolios, for Australian dollar portfolios, even if we've got any people out there on Novia with Australian clients, and you can explain and visualize why understanding currency is so vital to getting asset allocations right. Okay, I will stop there. That's what I've just said. There are some conclusions. Oh, look, that's us. We're excellent value for money. We've done very well. The sales team would want me to show you that. And oh, sorry, I shouldn't show any other platforms. I'm going to skip very fast through those other horrendous platforms so you're not misled away from your one true home at Novia Global. There's some better looking members of the team. Thank you, Linda.
I have to say, it was absolutely fascinating. As I said at the beginning, that side of our business is quite often missed because we are focused so much on performance and stock markets. And actually, the thing that drives it is the emotional side to it. So I found it absolutely fascinating. And as expected, everyone who's dialed in has also. So we've got a couple of really interesting questions, if I can field them to you. So we've had one question is, what role do you think financial advisors play in managing investors' anxiety and their expectations? And how can they better support clients during the bad and the good market conditions?
Yeah, well, I mean, hopefully I've articulated that. I think your capacity to help with and intervene in moments of anxiety is profoundly socially important. You know, governments are not giving people the retirement they need through benefits anymore, and that's not going to change with an aging population. If we want people who are living longer, if hopefully we're all going to live longer, to have decent retirements, we're going to need to stay in the stock market. And I think it would be horrendously sad if your just residual levels of bad mental health throughout your life were the thing that determined whether you were okay in retirement. And I think that financial advisors can change that. You mentioned controlling expectations. I think that is absolutely crucial, which is why I was banging on about not making promises you can't keep, not predicting a future that you can't predict, having all our portfolio illustration tools and everything so you can just show people at the moment, let me tell you what the worst year could look like. Here, look at it. If that happens, don't worry, it's in the plan. When we made this plan, we assumed we'd get some really bad years. So don't worry, like that expectation control at the start. And I think the final thing I'd say is, like, in our philosophy, we always say there is only one way to increase the predictability of a portfolio, right? To give you a higher probability of a really good outcome. I mean, people will say they can do it because they're just so clever and they're going to pick amazing stocks. There's no data to support that. The thing that makes a difference is if you are willing to say, I will forsake a really, really good outcome in exchange for the diversification and the use of defined return instruments and things that will enable me to have a good outcome in a far wider variety of circumstances. And if you can get investors to buy into that basic idea at the start, that you're going to do everything you can to give more good outcomes more often, and they won't ever get the very best, they won't ever get the very worst, but there are real things we can do to increase the probability of good outcomes. I think you're much likely to keep those investors on the journey. I hope.
Absolutely. And there's another question, so which I think is quite pertinent as well. So how significant do you think the role of investor education is in reducing those anxiety levels? And are there any specific resources, programs or educational resources that you could recommend that advisors can point their clients to?
Yeah. Yeah, so the answer is actually there is good data on it. I showed you that big study in America at the outset, and there is a strong correlation to education level. You'd have seen it in one of the uplines because it was the more education you got, the more you stayed in the stock market. But it's absolutely true that the least educated people generally experience more anxiety around their investments and therefore make poor, bad decisions. It's correlated both to levels of financial education and just overall levels of education. And so, there has to be a response to that because invariably we are going to find that our most anxious clients are much more correlated to our most vulnerable clients, and that's the reality. That's where we're going to find anxiety that's high. That's where we have to be most kind of protective. In terms of like resources, I mean, hopefully, things like our investors guide that will send you help, but really, what helps is really experienced advisors who just learn how to deal with people and help with people and spend time face to face with people. And it's election time. I won't make any party political points, but the government is not going to do very much for younger people today to provide them with anything which puts their finances in a good position, right? They're going to end up with lots of debt from universities. They're going to end up with an enormous amount of property debt. They're going to be exposed to a lot of credit card debt to deal with the cost of living crisis. And they are doing that with extraordinarily low levels of financial education. And if the only policy response is to more tightly control what the financial services industry says, I mean, they should control what we say, it should be accurate and fair. If the only policy response is that, I don't think anyone's going to learn anything. And so I think as an industry, we need to be much more forthright in saying that if we put money into financial education, it will pay us back many fold in the decisions that people make with their finances. A smaller group of people defaulting, a smaller group of people are entering financial difficulties, lower levels of stress in the banks. There is only economic upside from every party and putting some money into financial education and into, as an industry, us lobbying and fighting for that. That's my opinion anyway.
I personally agree from my personal perspective. I have two children and, there's no education at all on the financials. There's nothing at all in the curriculum. And that I think everything that you said today, if there was more of that within the curriculum, as people evolve, as people get jobs, they'd have much more intelligence around investing. There'll be better decisions made. There'll be more awareness. So I think presentations like yourselves, your presentation today is absolutely invaluable. There should be way more talking about this, discussing it, raising it, highlighting it. So hopefully everyone that's attended today has found a real benefit from this. We do send the slides out, so everyone that's registered will get the slides. The recorded presentation will also be on our YouTube channel. So please feel free to share this presentation and the slide deck with anyone else in your organisation you find it would be useful. There's some fantastic slides that Charlie's put together that really, I can imagine sitting there with my mom who's completely non-financial savvy at all, and she would grasp the concepts within this. So yeah, I think the content's been absolutely fantastic today. Brilliant presentation. Thank you so much for your time.
Thanks so much for having me. Thank you.
And as I say, this slide deck and the recording will be available. Our next presentation will be with QB Partners, and the information on that will be in our next Pulse newsletter. So look out for that. Thank you once again, Charlie. Thanks for everyone for dialing in, and look forward to seeing everyone at the next presentation. Thank you.
Thank you.